Well, data takes center stage on a quieter week for earnings. Thursday's inflation reading will be watched for signs of price pressures continuing to slow. But don't take your eye off the bond market. A deluge of fresh supply is a possible source for volatility for investors. The Treasury will sell around $103 billion of longer-term securities at its so-called quarterly refunding auctions. Now, that's more than most dealers anticipated. A big concern is that too much supply will overwhelm the market and impact important sources of funding. So what should we be looking for? Well, joining us now is Lawrence Dyer, HSBC's head of US rate strategy. Good to have you on. So first, give investors a breakdown of how important this week is going to be for the bond market.
Well, the quarterly refunding is always a big week for the bond market. People pay a lot of attention to just how that supply is absorbed, how quickly the market can reprice. And so we'll be looking at it very, very carefully. Now, does it change the long-term outlook for the market? Maybe not so much, but people have to price the day-to-day supply. And we're seeing a lot of volatility associated with that. The 10-year yield jumped from 3.80 up to 4.2% just in the past couple of weeks. And certainly supply and inflation uncertainty are two features driving that move.
And as we saw, bond market action, we saw the yields picking back up again, signaling at least some belief potentially that the Fed might be done with raising rates. But how should we be judging some of the bond market action that we're seeing, and how accurate of a reflection that is of where the Fed could be heading?
Well, the really funny thing is the front end of the market is held in pretty tightly. The 2-year note yield hasn't jumped to the same extent that we've seen 10-year and 30-year yields. So there's a bit of a confusion here, right? If the Fed was going to be more aggressive, you'd expect the 2-year note yield to be jumping and the yield curve either maintaining its slope or flattening. And instead, we've seen it steepen. So that speaks to the idea that people are questioning how should we price the long end of the market. And I think a lot of the headline risk is responsible for pushing up yields. We're back to levels near what we were seeing, say, in late 2022. And the fundamental market is different. In late 2022, there's a question of would inflation begin to get controlled? And today, inflation is stable, falling a little bit, not as fast as the Fed would like, but still much better controlled than we saw, say, last November. So it feels like maybe the market is overreacting, and we'll see how that plays out over the next week or so as we actually price the supply. Very often, if you want to buy a lot of bonds, you wait for the auction.
Indeed. And you have obviously some big names weighing in. You have Elon Musk touting the importance of T-bills. For people who are wondering, is it too late to get into these shorter term yields? Is there enough upside at this point that it's still worth getting in? How would you be viewing the action right now?
Well, T-bills are a point of safety, right? So you buy T-bills and you know you're going to get your money back and you have a lot of liquidity within them. So that's sort of a niche. Now, the other thing you could do is you could say, maybe I should buy the 2-year note. Maybe there's enough yield priced in the 2-year note so that it gives me a better value. And then as you move out the curve, you get more and more factors that you have to consider. So one of the models that we use says maybe 2-year notes should yield 5.3% if you believe the Fed. They're meaningfully below that today, so there's risk in the front end of the curve, and you might feel bills are okay. Now, you may talk about a huge supply in bills, but you also have to ask, why is that supply occurring? Wall Street is really good about yelling numbers, but why is equally important. The Treasury is increasing bill issuance in order to increase its account at the Fed. It has kind of a rainy day fund that it keeps at the Fed. Now, when the Treasury puts more money into the Fed, that means somebody else with money at the Fed loses that money. It's going to come back to them because the Treasury sets its money in. Either bank reserves fall or maybe money funds buy T-bills. And if they buy T-bills, what do they use to buy the money fund? To buy the T-bills, they take money out of the Fed account, which has reverse repos. So there are a lot of moving parts that you really have to look to. It's dangerous in the front end of the curve to just hear about one number. You have to think about how everything interconnects. So our analysis would say that a lot of supply is a $400 billion increase in Treasury bills, offsetting what had been a $400 billion decrease in the Treasury account at the Fed. So we're thinking a lot of the numbers add up ultimately, but that doesn't mean you're going to price them like unchanged this week. And that, I think, is the debate for the market to try to figure out as to just how it wants to absorb supply and how things would work. As I'd mentioned, if you wanted to buy a lot of treasuries, you'd wait for the auction. So it's going to be very exciting to see how they play out.
And of course, this is coming when we're going to be also getting CPI data out this week. How much do you think that's going to move the needle when it comes to volatility when you already have to factor in the auctions as well?
It was only a month ago that the market was rallying on CPI being below expectations. So that's going to be a key number for people to watch and to try to fit into this mosaic of all the different moving parts, right? Is inflation under control well enough so that the Fed would step back from having a relatively high Fed funds rate? Not likely. It's going to take a few months or more for that to occur. So the Fed's watching the number, but the market may overreact to it. And as I said, we had a big rally on low inflation, and then we had a big downtrade on supply fear. The market seems to focus on one thing at a time. I'd kind of blend them out and say maybe it's selling off more than we could justify at this point, and maybe it was too optimistic on inflation just a few weeks ago. So we're looking at that noise as a bit of an opportunity over time.
And so, Lawrence, as we look at this holistically, then, what does a new normal then eventually look like for the bond market? Being that obviously you had historically low interest rates for a very long time and people began to believe that was the new normal. But now in this current phase, what are the expectations then for the bond market?
I would look at it that if we go back to, say, 2012, 2013, there were strong headwinds for the economy, and the Fed kept talking lower for longer and pushing down long-term interest rates via that guidance. Now, what's happened since then is inflation jumped much more than the Fed would have expected. There are a bunch of causes for that. You can look to Ukraine, you can look to COVID, you can look to the unusual stimulus that's come into the economy. But as I look at the chart that you might be showing now with the Fed funds rate, think of it this way. When the Fed funds rate was peaking around 5.25 in 2006, 2007, that was roughly the expected nominal GDP rate for the economy. So that's a relationship that we've tracked carefully. And the reason we track it carefully is generally you see long-term interest rates and the Fed funds rate tending to peak around the GDP level. Now, if that's the case, we're actually restrictive today. The Fed tells us nominal GDP trend should be about 4%, and Fed funds is at 5%, and bond yields are at 4%. Historically, these have been relationships that have pushed down inflation. It just is, it takes time, right? It took a number of quarters for inflation to jump up. If I go back to the Volcker era, he was fighting inflation from 78 to 83. So I think the transitory view on inflation may have been a little bit too optimistic. That doesn't mean the Fed doesn't have the tools that it needs. It just means that maybe it takes time. Maybe it takes a year more than the Fed thought. Maybe it takes more than a year more. But the Fed has been able to control inflation since the 1980s. I wouldn't want to bet against it in the long run. And that's the debate that the market has to try to work its way out of in the next few weeks.
Indeed, trying not to fight the Fed, but markets not seemingly believing the Fed all the way, apparently, just yet. Thank you for that wonderful breakdown there for us. Lawrence Dyer, HSBC's head of US rate strategy. Thank you so much.